Call ratio spread versus callback spread. Have you ever wondered how different options strategies can impact your trading decisions? Today, we are going to compare the call ratio spread and the callback spread. Both strategies involve call options, but they serve different purposes and have distinct risk profiles. Let's break it down. First, let's look at the call ratio spread. This strategy typically involves buying a smaller number of call options at a lower strike price while selling a larger number of call options at a higher strike price. A common ratio is one call bought for every 2 or 3 calls sold. For example, you might buy one call option at strike price A and sell 2 call options at strike price B. The market outlook for a call ratio spread is moderately bullish. You expect the underlying stock to rise, but not exceed the higher strike price. The maximum profit occurs when the stock price is near the short strike at expiration. In this case, the sold calls expire worthless, and the long call gains value. However, the profit is capped because the extra short calls limit gains beyond the short strike. On the risk side, if the stock price rises sharply above the short strike, the risk can be significant. You are short more calls than you own, which can lead to potential unlimited losses. The cost to enter this strategy can vary, allowing for either a net debit or credit depending on the selected strikes and premiums. Now let's shift our focus to the callback spread. This strategy involves buying more call options than you sell. Typically, you would buy 2 or more calls at a higher strike price while selling fewer calls at a lower strike price. For instance, you might buy 2 calls at strike price B and sell 1 call at strike price A. The market outlook for a callback spread is very bullish. You anticipate a significant upward move in the underlying asset. The risk is limited to the net debit paid for entering the trade, while the profit potential is unlimited if the stock price rises sharply above the higher strike. Interestingly, this strategy can also yield small profits if the stock price falls below the lower strike, depending on the premiums involved. In terms of costs, a callback spread is usually entered for a net debit, as the cost of the extra long calls typically exceeds the premium received from selling fewer calls. So, what are the key differences between these two strategies? The call ratio spread sells more calls than it buys, while the callback spread buys more calls than it sells. The call ratio spread is moderately bullish with capped profit potential and a risk of large losses if the stock surges. In contrast, the callback spread is very bullish with unlimited profit potential and limited risk. When deciding which strategy to use, consider your market outlook. Use a call ratio spread if you expect a moderate rise in the stock price and want to generate income or reduce costs. On the other hand, opt for a callback spread if you anticipate a strong bullish breakout or significant upward volatility. Both strategies requiring careful management of strike selection and monitoring. The presence of naked short calls in the call ratio spread can lead to substantial losses if the underlying moves sharply beyond the short strike. The callback spread is generally safer in terms of risk but requires a strong bullish conviction.